Okay, so frustrating both the bulls and the bears. That's how the year could shape up. Abhilash Narayan, the Senior Investment Strategist, Group Wealth Management at Standard Chartered Bank, joins us now to talk about that. Abhilash, good morning. Do you reckon that this could be a frustrating year for investors when nothing much really happens? It's absolutely range-bound, and it could even be a time-wise correction for markets, including India?
Well, yeah, absolutely. I think this is a year where volatility will be quite elevated, and that's something we have been calling out, for the past few months. And if you look at what's happening in U.S. equities, it's a classic sort of bear market rally that we saw in the past few weeks. And now, given the strong data that's coming through, markets are treating good data or good news as bad news. So, it will be a choppy market, and that's why it's important to remain diversified as we go through the year.
Hi, Abhilash. Morning, Nigel here. Abhilash, JP Morgan's asset management strategist last night, I was listening to what she had to say to CNBC. She said the market is seeing an overheat before the retreat. Do you think that's going to happen?
Well, assuming that she's saying that markets could rally a bit more before stock markets fall, I think that's certainly possible, right? And on our end at Standard Chartered, we have been more cautious on equities, and the key reason for that had been earnings. So back in December, when we had our last chat, U.S. equities earnings expectations were at 6%. Right now, they're at 1.5% for 2023. And if you look at what happens to U.S. earnings in recession, so we did an analysis since 1960. On an average, earnings contract by 11% during recessions. And given the high likelihood of a recession in US this year, we think that there is more room for earnings to disappoint investors. So yes, in the near term, could we touch 4,200 for S&P? That's certainly possible. But we think that will be followed by a pullback or a consolidation as PE ratios will become more expensive.
I mean, it's crazy, right? US economy is getting stronger and stronger. And calls for a recession are getting stronger and stronger. it's just so it's upside down, really. But that's how it's been now, at least for the last 15 years, isn't it, Abhilash? What's your sense, though, in terms of emerging markets? How will there are two ways. One is, of course, if we get higher rates in the US, which they'll have to do if to cool things down. Is that more preferable? What does it mean for capital flows, just a quick sense on EM flows in the context of what's happening overseas?
Yeah, so I think in the near term, obviously there is a possibility that the flows to emerging markets could suffer a bit because of any sort of risk of bout that we see, and the fact is that U.S. government bond yields are becoming more attractive at the margin, right? One of the key advantages emerging markets had was higher yields on offer, as well as stronger growth potential. So as far as the bond markets are concerned, we think that advantage is eroding a bit in some parts. But that being said, you also have to take into account the fact that emerging markets are much more advanced in their rate hiking cycles, and you could see a few emerging markets also start to cut rates this year. So the picture is a bit balanced as far as bond flows are concerned. If we shift our focus to equities, we think emerging market equities should still continue to see broad-based inflows because one, the investor positioning is not that stretched, and secondly, emerging markets is where growth is. China, India, Indonesia, Malaysia, all are expected to grow in a robust manner. So yes, there will be some downbeat sentiment from US and European slowdown in the later part of the year, but money flows to where growth is, where potential for higher returns is. So emerging market equities should still continue to do well.
Okay, all right. We will leave it at that. Thanks a lot, Abhilash, for joining in. Although emerging market equities may continue to do well, what stays with me is, you're saying that you're still cautious on equities overall for the year. So I guess, that's the sum and substance of the discussion. Stay cautious on equities this year. Let's slip into a quick break. Lots coming up on the other side. Plenty of stocks in focus as well. Our entire research team will be here to prep us for the day. Do stay tuned in.